Welcome back to Intelligent Investment Today, the show dedicated to bringing you everything value investing. In each episode, we take a different topic from the world of investment and try to apply the lessons laid down by the man considered the father of the craft, Benjamin Graham, to the matter at hand. In this edition, we're going to be trying something just a little bit different. We're going to dream up a fictional business. I'll present all its charming and not so charming features before deciding whether it's a hot prospect from a value investment point of view. And to make things more interesting, and to highlight the difference in philosophy between my two great heroes, Benjamin Graham and Warren Buffett, we'll look at how their opinions might converge or differ. So let's get right down to it. As always, kick back, strap in, and get ready to take on board another lesson in value investing, as inspired by Benjamin Graham. So let's first set the scene. Today I've been handed a file of information on a mysterious company called West Widgets. The business is fictional. At least I hope it is. But let's imagine, just for today, that it's a real going concern producing custom-built metal widgets used in farming and factory machinery. Not glamorous, not flashy, not trending on social media. Earnings have been stable for years. And already it sounds boring and predictable enough to have been overlooked by the wider investing public, which means it might just be undervalued. So, do we have a gem hiding in plain sight, or a value trap? The first thing to note, it hasn't been a great year for West Widgets. Its stock is down around 35% over the last 12 months. Analysts say that the industry is declining. Most investors are ignoring it. This sounds exactly like the kind of unloved, overlooked company that value investors, especially Benjamin Graham, would have been drawn to. But of course, surface impressions are only the beginning. A falling stock price might mean opportunity, but it could just as easily signal danger. So let's dig a little bit deeper and look under the hood. Regular listeners will know that Graham's approach started, and if we're honest, often ended with a forensic look at the numbers. The accounts were his clues as to whether a business was a screaming buy or a ticking time bomb. And he always demanded a healthy margin of safety. He didn't just want to pay slightly less than a business was worth. He wanted to pay far less. If a company was fairly worth $20 a share, Graham might only be willing to pay 12 or 13. That gap between intrinsic value and the purchase price was his margin of safety. So let's say we've crunched the numbers, we've examined the key financial statements, the profit and loss account, the balance sheet, and the cash flow statement, and not just for the current year, but going back a full decade. What exactly would Graham be looking for when interrogating these documents? He'd like to see earnings stability across many years. The steadier the earnings, the more confidence he'd have that the past is a reasonable guide to the future. He'd examine assets minus liabilities to see whether the stock trades below net current assets. Good assets, after all, are like money in the bank. So how does West Widgets stack up? Revenue has been stable for a decade. Earnings fluctuate slightly but stay positive. The company holds valuable factory equipment and a substantial inventory. Debt is minimal. And remarkably, current assets, cash, receivables and inventory, minus all liabilities, almost equals the entire market cap. That's a big classic Graham-style green flag. To understand why the stock price might be so out of line with the financials, we have to consider Mr. Market. And today he's depressed about manufacturing. He thinks it's old, boring and doomed. So he slashes prices on every industrial stock, regardless of whether the underlying businesses are actually deteriorating. Graham, of course, would remind us not to confuse Mr. Market's mood with the company's reality. West Widgets might be mediocre in many ways, but on quantitative grounds it seems undervalued, and would likely be considered for purchase by Graham. Now enter the Oracle of Omaha, Warren Buffett. Would he, if presented with exactly the same facts, interpret them in the same way as his mentor? Very early in his career, he probably would have. He was quite fond of Graham-style cigar butt businesses. Companies you could find laying in the gutter, a bit disgusting, but cheap and with one free puff left. But Buffett has refined Graham's approach over the years. Whereas Graham focused almost exclusively on the numbers, Buffett added something more: business intuition. He cares not only about buying cheaply, but about the quality of the business. He likes to think like an owner. If you bought 100% of Northwest Widgets, would you feel proud? Would you sleep well at night? So let's imagine we do own the whole business and take a walk across the imaginary factory floor. What moats protect it from its competitors? Does Northwest Widgets even have one? Maybe would find long-term contracts with customers. And why would those customers want long-term agreements? Because their widgets don't break. And when your machinery costs millions, you'd rather pay a bit more for reliability. Buffett also points out that you can't make a good deal with a bad person. Luckily for us, Northwest Widgets CEO is a frugal engineer who knows the business inside out. Even better, he's famous for turning down the flashy perks that usually come with the job. He knows all his employees well and avoids debt. Buffett would certainly approve. Another thing Buffett looks for is the ability to compound over the long term. Graham might buy a stock simply because it's cheap. Buffett thinks more about whether the business can make him money decade after decade. If Northwest Widgets reinvests its earnings wisely, on better machines, more efficient processes, or on new product lines, its value could very well grow slowly but steadily. Buffett isn't seeking a quick buck. He wants a company that held for 20 or 30 years will treat him well. So after all this, what is the verdict? Let's recap first the positives. A strong balance sheet, cheap valuation, low debt, intrinsic value above stock price, competent management, a decent moat, and stable earnings. It is true that the business does operate in an industry that may be in long-term decline. There's also innovation risk. The possibility that new technology makes the widget obsolete. The verdict: Northwest Widgets seems like a cautious buy, but not a screaming bargain, and not a guaranteed compounder, but a solid, durable business trading at a discount with respectable long-term prospects. Graham would probably buy and wait patiently for value to be realised. Buffett might also buy, but only after touring the plant and confirming the moat was real. What we can say is that Northwest is not a value trap. It is a legitimate value opportunity, if you have the patience. So let's wrap up with a quick summary. Graham teaches us to begin with the facts. Buffett reminds us to understand the business, not just the spreadsheet. Using a margin of safety protects you from the unknown. When you have a large enough discount, small mistakes won't sink you. Ignore Mr. Market's mood swings and remember, the market is emotional, but the businesses are rational. Whether you follow Graham strictly or lean towards the Buffett approach, you'll likely do just fine. The difference ultimately comes down to this. Graham's scientific approach can be taught. Given effort, almost anyone can learn to spot an undervalued opportunity. Buffett, on the other hand, is something of a one-off. His instinct for qualitative business factors is more art than science and is harder to replicate. That's not to say we can't learn from him. It simply means his conclusions rely more on intuition and experience. Ideally, we blend both approaches. Start with Graham, Find a business selling far below intrinsic value, giving a strong margin of safety. Then apply Buffett-like qualitative analysis to make the case even stronger. And with that, we'll bring this episode of Intelligent Investment Today to a close. I hope you've enjoyed exploring the similarities and differences between the Graham and Buffett approaches, and that it brings you one step closer to becoming the best value investor you can be. If you've enjoyed this episode, please press that subscribe button, or at least add it to your playlist, so you never need miss a future edition. Come on, ladies and gents, throw me a bone here. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.